You've been lied to about debt. You've been told to avoid it at all costs. But what if I told you that the rich use debt to get richer every single day? Now, we've all heard the saying, never get into debt. Financial slavery and all these other sayings that people say. It's a little bit true, but that's only applied to the wrong debt. Credit cards, payday loans, high interest car payments. Let's explore more how the rich and elite use debt to build wealth and how you can start thinking about it a little bit differently too. Real estate investing, right? This is what people refer to as a millionaire shortcut because this is one type of debt that millionaires love. It's real estate debt, especially when you can refinance it. And that comes with high credit scores, which we'll talk about later. Let's break this down with a practical example. Let's say you saved up $200,000. But in today's real estate market, that's not a lot. It's just a start. So you use it as a 20% down payment on $1 million property. You owe 80% of the property. Now, let's say over the next 10 years, that property doubles in value. In this particular case, the house doubled in value. That's 100% gain. But because you only put in the original $200,000, you made more than that. You sell the house for $2 million. You pay off that original $800,000 mortgage that you had, and you're left with $1.2 million. You didn't just make one times the original investment. You made 6 times because you turned $200,000 into the $1.2 million profit. That's another way that leveraging debt works in real estate. Rich do it all the time. Now, number 2 is borrowing against your crypto or stocks if you're an investor in either one. We always hear about people like Jeff Bezos, Elon Musk, taking loans out against their stock to avoid taxes. I'm going to explain to you how this is one of the coldest moves in the financial playbook. Most people have never even heard of it. The rich don't sell assets, they borrow against them. Now, remember, when you sell an asset, you have to pay taxes. But what if you never sell? What if you use those assets as collaterals for loans and you reinvest in real estate, reinvest in other things? There's no tax trigger and you have instant access to your cash. This play is all about strategic risk. It's one of the best ways the wealthy grow cash flow without triggering taxes, without selling what they see will appreciate into the future in value. Now, let me break this down with a simple example. Let's say your Bitcoin is worth $250,000. You need $100,000 in cash. If you sell, you not only lose the potential future gains of Bitcoin, but you also get taxed on the profit, up to 20 to 30%. If you take the $250 in Bitcoin, you sell $100,000 worth. You have to pay $30,000 in taxes and you end up with $70,000. And again, you cannot participate in the growth of Bitcoin into the future because you've already sold. So instead of doing that, you can borrow against your crypto. You take the $250, you take out a $100,000 loan. Now, there is very small interest on this loan, but the good thing about it is that you get the full $100,000. Now it's a loan, and you do have to pay it back, but you didn't have to pay the taxes on it. Pay around 5% interest, no taxes. Don't have to sell. You continue to appreciate. Now, let's say this. Bitcoin doubles over the next 3 years. So now you have $500,000 in Bitcoin because you didn't sell. Now, you can use some of that to pay off that loan and now you end up with $400,000. And your loan is taken care of. You had access to the money earlier. You took some of that money and maybe you took this and invested in a real estate property. Now you have the house and you also have the Bitcoin at the end of the term. This is what the rich do. Now, in the first example, I only had $150,000 left. So if it doubled in that time, I would have $300,000. So you see, I made an extra 33% return, and I also had the money to invest in another opportunity earlier and also took advantage of that appreciation over those 3 years. That's how the rich leverage debt to increase their assets over time. So Bitcoin continued to rise. You benefited from that full $250,000 position. You got liquid cash. You deployed it elsewhere. Your borrowed money wasn't taxed. You used somebody else's money to buy more appreciating assets. You paid back the debt slowly. Let inflation eat away at the real cost of that debt. You can do this with margin loans or portfolio-backed lending with stocks. You can do this with crypto platforms like Nexo. Coinbase has a borrowing protocol. You can even do this with real estate through HELOCs or cash-out refis. Number 3 is you can use a loan to buy a cash flow in business. Now, why would you want to do that? Because with this strategy, you get paid from day one. It's one of the smartest ways to use debt, especially for aspiring entrepreneurs. Because you buy a business that's already making money with debt. Instead of starting from scratch, you buy something that's already has momentum, already producing cash flow. Now, if it's done right, the business pays off the loan for you. Many people don't know this, but the U.S. government has a program for small businesses through a program called the Small Business Administration, or SBA. An SBA is a government organization that stimulates the business economy. They offer low interest rates, long terms, up to 10 years, and very low down payments, as low as 10%, specifically to help people buy existing businesses. Now, let's break this down. You find a business that makes $20,000 a month in profit. So you negotiate a sale price of about $600,000. So your monthly debt service, or what you have to pay towards the loan, is $6,000. So here's the math. The business brings in $20K. Loan payment is $6,000 a month. So you pocket the remaining $14,000 a month in profit. Now, the business does require some work, but you just acquired a profitable business using mostly debt. And you're already making cash flow from day one. That's leverage in action. That's how private equity and acquisition deals work. When you hear about these corporations acquiring these companies for hundreds of millions or billions of dollars, and you wonder, where do they get this money from? Well, they get it from a loan. They look at a company, they do this same math, but on a larger scale, and they buy the company with debt. The debt service, what you pay monthly on the loan, is lower than what the company generates in profit. Therefore, you get a positive in revenue. And over time, the $6,000 a month will pay the business off. If the term was 10 years, in 10 years, you paid off the business has value, and you're also generating a full $20,000 a month in profit. Now you have the business and you have the profit. The business also has value, and you can sell that down the line for probably more at that point. And you can also use some of the money invested back in the business and grow the business to a higher valuation. Valuation is based on how much you make per month. You get that number up. The business itself is worth more, and you sell that business down the line for more. Now, the key is the business's monthly profit, $20,000 here, has to exceed what you pay every month on the loan. That positive difference, the $14K, is yours to keep, and the business itself will be paid off over time. Number 4 is short selling. The average investor buys stocks hoping that they'll rise. Savvy investors, they practice something called short selling. It's one of the most innovative debt moves in the financial world, and it actually is pretty smart. Let me break this down. Let's say you expect Facebook to drop in value. Now, let's just say Facebook is $100. So one share of Meta is $100. So you want to do what's called shorting this stock. That means you want to borrow a stock from your broker. Yeah, you can borrow stocks from brokers. They make money through the brokers by allowing people to borrow it as long as they pay it back at under certain criteria. A short seller would borrow one Meta stock from the broker. They would sell it instantly for $100. They borrowed a stock, not cash. They borrowed the stocks. You have to return one stock back to the broker in a certain amount of time. Let's say you believe that Facebook was going to drop. It crashes to $70. So you buy that share back at the $70 using the cash that you made initially from selling that loan stock. Now, that leaves you with $30 left over. You take the $100, you buy the stock, you return it back to the original loaner, the stock, not the money, and you keep that $30 remaining in your pocket. Now, you never own the stock. You bought it. You debt to generate a return. Now, multiply this process by millions of shares, and you get the scale that the rich and the elite operate on. But it's risky. If you're wrong, let's say Facebook, instead of going down to 70, it actually went up to 200. You're obligated to buy a share back and give it to the broker. From that $100 that you made initially, you have to add $100 out of your own pocket to get to the $200 mark, to buy that stock back and get it back to the original loaner. So that's the risk. I always give people this example to make shorting simpler. You have a friend, he's moving to Europe for a year. He has a Honda. You look at that Honda, you say, can I borrow your Honda? And he says, yeah, you can borrow it. I don't care what you do with it over the year, but when I get back next year, I need to have my Honda here. The same make, same model. Okay, that's cool. So you look at the Honda, it's worth $20,000. He goes off to Europe. You sell the Honda. You take that $20,000, you put it in your pocket. But as you understand it, in a year, cars normally drop in value. So you put that $20,000 in the bank. You wait for a year. He's off in Europe doing this thing. He calls you back up and says, I'm coming back next week. So you go back to the car lot. You find a Honda that's the same Honda, similar miles, everything, same color. So you don't know the difference. And now the cars are $15,000. So you take that $15,000 you sold for last year. You buy that Honda back. You give him back his Honda. He doesn't care. He has his Honda, same mile, same color, looks the same condition. But you now have $5,000 in your pocket because you have effectively shorted that car. You borrowed an asset from your friend. You waited over time because you anticipated that that asset would drop in value. And you paid him back the asset and you kept the difference in the price. And that's effectively how shorting works. Now, number 5 is keeping your credit score high. None of these things work unless your credit score is high. That's your access key to cheap money. Now, you want to use debt the smart way. It starts with credit score. If your score is high, banks fight over you. They offer lower interest rates, better terms, higher limits. If your score is low, you're stuck with payday loans. Those are horrible, by the way. High interest credit card debt and predatory lenders. Rich people treat their credit profiles like gold because it is. Your credit score is your trust score. It tells lenders, yes, I know how to handle the money you're going to give me, and I will pay it back. And when you prove that, your access to capital becomes unlimited. Now, when you get access to capital, you get leverage. And with leverage, you build wealth. Banks are in the business of lending money. They want to give you the money. It's just sitting in their vaults, but they can only do that with people who understand how to manage risk. Even when money doesn't exist yet, banks can create it through fractional reserve banking. That's right. They can literally create money out of thin air, but that's a video for another day. I appreciate you guys. Drop a comment if you want me to discuss another topic, and please subscribe to the channel. I appreciate you and have a great day.